Hey guys, it's Mayor here and welcome to the YouTube channel. In today's video, I'm going to explore with you how index funds and ETFs can really supercharge your investments moving forward. So we'll first start off exactly with what are index funds? Why are they super popular? And what exactly are ETFs? What's the difference? What are the similarities? And which one should you choose? Index funds are specifically investment funds that aim to replicate a specific market index, for example, the Dow Jones Industrial Average or the S&P 500. So unlike actively managed funds, which there's a fund manager kind of choosing the investments for you, index funds are passively tracking a specific index, hence the name index funds. So imagine you're in a big city, for example, like New York City, here in the United States. And let's say you're surrounded by big businesses all around you. Well, these big businesses are most likely going to be traded as companies. Each of these businesses, therefore, represents a certain stock in the stock market. And let's say you want to invest in something very particular. For example, you want to invest in the top 500 companies within the United States stock market. That's exactly where index funds come in because there is an approach for that. For example, a basket of 500 of the biggest companies in the United States that you have the choice and the luxury to invest in. Rather than investing in perhaps just one or two specific stocks, you can invest in all of them at a certain weight and a certain proportion, which is a little bit more diversified and a little bit less risky compared to investing in one specific company that may go up or may go down. Quite simply, index funds are a very straightforward way for investors to get broad diversification at a very, very low cost. Why are they super beneficial? I've highlighted some in the very beginning of this video, but let's dive a little bit deeper so that you have clarity in terms of why index funds are a very popular choice for many investors in today's day and time. First and foremost, index funds are known for their super low costs. Since they don't require these fund managers and active investing, usually in turn there's lower costs associated with these types of funds. And that's beneficial for you as an investor because that means more of your hard-earned money is growing and investing over time. And as I mentioned, index funds offer broad diversification in a single fund, allowing you to really trade just one fund and have a basket of different companies at your realm. And this is super important because when you have broad diversification and you have weights in different companies, that means if one company goes up or one company goes down, it's not going to impact the total value of your fund because the index, in essence, has all these different companies by weightage. So I want to explore ETFs and I'll explain what ETFs are, but ETFs are essentially index funds as a stock. So ETFs stand for exchange traded funds. Both ETFs and index funds seek to track a specific index, but there are differences in terms of how they're traded in the market. So index funds are essentially mutual funds that pool money from multiple investors to purchase a diversified portfolio of stocks or even other securities that mirror the composition of that specific particular market index. They're priced at the end of the trading day based on the net asset value, which is also known as the NAV, of the underlying securities that are existent in that specific fund. And index funds are really interesting because they're bought and sold directly through the fund company or brokerage firm, and typically there's no commission fees. ETFs, on the contrary, are investment funds traded on stock exchanges similar to individual stocks. ETFs hold assets such as stocks, bonds, commodities, and can track various indices and sectors, and they can be bought and sold throughout the trading day at market-determined prices, providing intraday liquidity and flexibility. And ETFs are one of my favorite investment strategies, and it's very simple, just like trading a specific company and a specific stock in the market, except you're just buying an ETF. So let's actually take a real-life example of this so it's a little bit clearer for you to understand. So one of my favorite ETFs that's out there today, it's called the VTI Vanguard Total Market ETF. It's super great because it's very diversified and it seeks to replicate the total US stock market. So to begin, VTI has an expense ratio of about 0.03%, which means that for every $10,000 that you invest, you'd pay about $3 annually in fees. So really not a lot. The number of holdings in terms of broad diversification it's really high, which is a good thing. There's thousands of stocks giving investors like you exposure to the entire US stock market. In addition to these benefits that I've already explained, VTI also pays dividends, which is essentially money going in your pocket just because you're holding that specific ETF. And VTI's performance mirrors that of the total US stock market index. And that's really good because that means it's composed of large, mid-cap, small-cap, and micro-cap stocks. And over the long term, it aims to provide investors with returns similar to the US market. So that means if you believe that the US market's going to go up over time as a whole, then this is a really good option for you. And I believe that. That's why, clearly, something that I vouch for. And again, it's really up to your taste and preferences. There's also ETFs that are specific for international exposure, meaning if you believe there's a certain international market that's going to grow, you can purely invest in that as well. So you can see here that in the short run, VTI doesn't look like it's performing that well. But over time, as I pick the different options on the screen, you can see that in the long run, VTI has performed fairly well. And as you can see, if you invested some money in 2010, whether it was $10 or $100, it would have definitely gone up a lot today because the general US market increased over time. And here are some of the holdings that are contained within VTI. Some really familiar named companies that have pretty strong performance over time. So there's really 5 main factors when you're choosing the right index fund. Firstly, there's the investment goals as an investor yourself. Secondly, there's the expense ratios associated with the ETF. Thirdly, there's the fund size and the liquidity of the ETF. Fourth, there's the historical performance, meaning how well did that ETF do in the past. And last but not least, there's diversification. So in terms of the key indicators to look for when we begin with the investment goals, I would recommend yourself as an investor to scale from 1 to 10 what specific indicators that you're looking for and what specific parameters you're looking for to help deduce what ETF is the right one for you. Secondly, regarding the expense ratios, lower the better. In my opinion, below 0.5% is really what's preferred. In terms of fund size and liquidity, as long as it's above, I would say around 800 million or 1 billion US dollars, that would also be preferable in terms of ensuring that it's a credible ETF. Historical performance, you're really looking at your annualized returns, meaning for 1 year, how did that ETF perform in terms of a percentage value? Obviously, the higher is the better. So meaning the higher the percent in terms of the return, the more money you're making in return, and the lower, sometimes even negative, you may be losing money. The ETFs, you're not really seeing on average, on the long run, negative values in terms of annualized returns because they're very diversified. That brings me to my next point, which is the diversification. And the more number of holdings that you have, the better. Above 100 holdings would be ideal for a specific ETF in terms of broad diversification. So again, to really simplify the benefits of ETFs and index funds, ETFs are a great option because they're low cost, as I mentioned, and you can clearly see. They're broadly diversified. There's flexibility in terms of a specific index that you're looking for, as well as there's the potential for growth in terms of knowing that you believe in a specific index or a specific market. And lastly, there's a lot of customization because there's so many different types of ETFs that are out there regarding specific industries or trends that are designed to enhance specific returns and reduce risk for you as an investor. And these days, regarding innovation, there's many different types of ETFs that people look for, whether it's specific to an industry or specific to a market. And that's the beauty of it because you pick exactly what it is that you're looking for. And by harnessing these benefits of ETFs, investors can really pursue their financial objectives with confidence as well as with efficiency. So I really recommend you to take a look at it. And if you really like this video, please give it a thumbs up and subscribe if you can. It'd really help me out. And stay tuned for more updates and more videos on the topic. Thanks. See you in the next video.